Social Security changes 2026. What you need to do now. Social Security is changing in 2026, and millions of retirees are completely unprepared for what is coming. If you currently receive Social Security benefits, or if you are planning to claim in the next few years, you need to pay very close attention to the adjustments taking effect this January. The Social Security Administration has confirmed a 2.8% cost of living adjustment, or COLA. While any increase sounds like fantastic news, there is a hidden catch that is going to drag millions of retirees into a higher tax bracket and trigger unexpected Medicare premium surcharges. Today, I am going to explain exactly how these changes impact your bottom line, how much it will cost you, and what you need to check right now before the new year hits. Let us start with the numbers, because they are significant. Beginning in January 2026, the 2.8% COLA will boost benefits for nearly 71 million Americans. For the average retired worker, this means an increase of about $56 per month, bringing the average monthly check to $2,071. If you are a high earner who waited until age 70 to claim your maximum benefit, your monthly check could rise to over $5,180. Over the course of a year, that is a substantial foundation for your retirement income. But here's the problem. While your benefits are increasing to keep pace with inflation, the tax thresholds that determine whether your Social Security is taxed have not changed in decades. Do you see the issue? Since 1984, the IRS has used a formula called combined income to determine if your Social Security benefits are taxable. Your combined income is your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefits. If you are single and your combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If your combined income is over $34,000, up to 85% of your benefits are subject to federal income tax. For married couples filing jointly, those thresholds are $32,000 and $44,000. Because these thresholds are not adjusted for inflation, every time you get a COLA increase, you are pushed closer to or further over these tax limits. This means that the 2.8% increase in your monthly check could be the exact amount that pushes your combined income over the $34,000 or $44,000 mark. If you have a traditional 401k, a traditional IRA, or a part-time job, that extra $56 a month from Social Security could trigger a tax bill on up to 85% of your total benefits. This is what economists call a stealth tax, and it targets retirees living on fixed incomes who are simply trying to keep up with the rising cost of groceries and utilities. So who exactly gets caught by this? If your only source of income is Social Security and you do not have a single penny coming in from anywhere else, you are generally safe. You will likely fall below the taxable thresholds. However, if you are one of the millions of people who do have other income, perhaps required minimum distributions from an IRA, capital gains from a brokerage account, or rental income, you need to understand how the IRS is going to treat your 2026 benefits. This brings us to the most important part of this video, what you need to do right now to protect yourself. First, you must review your tax withholding. Unlike a regular paycheck, taxes are not automatically withheld from your Social Security benefits unless you explicitly ask the Social Security Administration to do so. If you suspect that your 2026 COLA increase will push you into a taxable situation, you can submit Form W-4V to the IRS to have 7, 10, 12, or 22% of your monthly benefit withheld for federal taxes. Doing this now can prevent a massive unexpected tax bill and potential underpayment penalties when you file your return next April. Second, you need to aggressively manage your combined income. If you have savings sitting in a standard bank account generating interest, or if you are planning to sell stocks in a taxable brokerage account, you need to be strategic. Consider shifting your withdrawal strategy to favor Roth IRAs or Roth 401ks if you have them. Qualified withdrawals from Roth accounts do not count toward your combined income, meaning they will not trigger taxes on your Social Security benefits. It is one of the most effective ways to keep your taxable income down and protect your Social Security from the IRS. Third, if you are approaching age 73, you need to prepare for required minimum distributions, or RMDs. Under the Secure 2.0 Act, you must begin taking mandatory taxable withdrawals from your traditional IRAs and 401ks at age 73. These RMDs will dramatically increase your combined income and almost certainly force up to 85% of your Social Security benefits into the taxable bracket. If you are still in your 60s, you should seriously consider executing Roth conversions now, while you have control over your tax bracket to reduce the size of those future RMDs. Finally, you must check your Medicare Part B premiums. The standard Part B premium is deducted directly from your Social Security check. While the hold harmless provision prevents your Part B premium from increasing more than your COLA, high earners face an entirely different problem, IRMA, the income-related monthly adjustment amount. If your modified adjusted gross income from 2 years ago, in this case your 2024 tax return, exceeded certain limits, you will be hit with a massive surcharge on your Medicare premiums in 2026. The COLA increase combined with RMDs can easily push you into an IRMA bracket, significantly reducing the actual cash you receive each month. The Social Security changes coming in 2026 are a wake-up call. The days of treating your Social Security as a completely tax-free bonus are over. You need to review your income sources, check your combined income thresholds, and start sheltering your withdrawals today. If you found this urgent update helpful, please hit the like button and subscribe to the channel. I will be tracking these changes closely and bringing you the latest strategies to protect your retirement income. Thanks for watching, and I will see you in the next one.